Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial mysteries lurking in corporate filings. Today we are diving into American Clean Resources Group Incorporated's latest quarterly report, and let's just say there are some very interesting numbers to unpack here. Alright, so American Clean Resources Group Incorporated, or ACRG as they are known by their ticker symbol, has released their quarterly report. This is essentially a snapshot of their financial health for the 9 months ending the 30th of September 2025. Think of it as their report card for that period, and we are here to give it a grade. Let us jump straight into the financials because that is where the real story often lies. Looking at their balance sheet as of the 30th of September 2025, we see cash sitting at a little over $7,800. Now compare that to the 31st of December 2024, where they had about $719. So a slight increase in cash, but still a very small amount for a company of this nature. What really stands out is their mineral rights asset valued at nearly $3.9 million. This is a significant portion of their total assets, which are just under $3.9 million. This tells us that the company is heavily banking on these mineral rights for its future value. They are essentially saying these rights are worth a lot and are not exposed to impairment, which is a good sign for that specific asset. Now, let's talk about liabilities. They have convertible promissory notes, and a big chunk of these are from related parties. This means money borrowed from individuals or entities closely connected to the company. As of the 30th of September 2025, these notes total over $1.2 million. That is a significant sum compared to the $425,000 from December 2024. It shows they are relying more on this type of financing. Adding to that, they have accrued interest on these notes, and this number is quite large, over $2.3 million. This indicates that a substantial amount of interest has built up over time that they still owe. This is a consistent and growing issue, showing the cost of carrying this debt. When we look at the bottom line of the balance sheet, we see a stockholders' deficit. Normally, you want a stockholder's equity to be positive, meaning the owner's stake is worth more than the company's debts. Here, they have a substantial deficit of over $11.5 million. This means that if the company were to liquidate all its assets today, there would not be enough to cover all its liabilities, and the shareholders would lose their investment. This is a critical indicator of financial distress. Moving on to the income statement, let us look at their performance. For the 9 months ended the 30th of September 2025, their net loss was over $1.2 million. In the same period in 2024, the net loss was over $1 million. This shows a widening loss, meaning they are spending more money than they are earning, and this gap is growing. A big chunk of their expenses comes from general and administrative costs. For the 9 months, these were over $916,000 compared to around $768,000 in the prior year. That is a roughly 19% increase. The company blames this on higher consulting, professional fees, and engineering costs as they work towards getting their processing facility operational. Then there is interest expense, which also ballooned by about 25% to over $348,000 for the 9 months. This is directly tied to the increase in their debt. All these rising costs without any revenue to offset them directly contribute to their growing net loss. So the big takeaway here is that the company is losing money and the amount it is losing is increasing. For the 9 months ended the 30th of September 2025, the net loss was around $1.2 million. This is a significant amount for a company with very little cash on hand. Looking at the statement of changes in stockholders' deficit, we can see how the deficit grows. In the 9 months ending the 30th of September 2025, the accumulated deficit increased by another $1.25 million, mostly due to the net loss. The company also issued some shares for services, which increased the additional paid-in capital slightly, but did not offset the overall negative trend in the deficit. The statement of cash flows is crucial for understanding the actual movement of money. For the 9 months ended the 30th of September 2025, they used over $851,000 in operating activities. This means their day-to-day business operations are burning through cash. On the flip side, they brought in over $858,000 from financing activities, largely from those convertible notes from related parties. This helped cover some of the cash burn from operations, but it also means more debt. The fact that their cash provided by financing activities is higher than their cash used in operating activities might sound good, but it is essentially borrowing money to stay afloat. And where does this leave them with cash? Well, it ended the period at just $7,850. This is critically low. It means they have very little cushion to handle unexpected expenses or delays in getting their operations up and running. Now, let's look at the notes to these financial statements. They explain many of the details. This section is particularly important. The company explicitly states that these factors, among others, raise substantial doubt about the company's ability to continue as a going concern for the next 12 months from the date these financial statements were issued. This is a major red flag, saying that there is a real possibility they might not be able to continue operating if they do not get more money soon. Their survival hinges on finding more funding. Regarding those mineral rights we saw on the balance sheet, the company says they are preparing the Tonopah property for constructing a processing facility. They believe the value of their land, mineral rights, and water rights, which is that $3.8 million figure, is still appropriate and not losing value. This is key because if these assets were impaired, their balance sheet would look even worse. They also talk about developed technology they acquired. It seems they bought Swiss LLC, incurring a purchase price of over $5 million, mostly in company stock. This technology is being amortized, meaning its value is gradually written off over its useful life, which they estimate at 14 years. However, in 2024, they recorded a full impairment charge of over $4.5 million on this technology. Indicating that the technology they acquired quickly lost its perceived value, which is concerning. The debt situation is quite complex. They have a line of credit with Granite Peak Resources LLC or GPR, a related party and their majority shareholder. This line of credit has been increased multiple times and has seen various obligations consolidated into it. As of the 30th of September 2025, the outstanding balance, including principal and interest, is over $1.3 million. This has been a primary source of funding, but it also means a significant portion of their debt is tied to a related party. The preferred stock section is also interesting. They have series of preferred stock, which has a liquidation preference of $10 million. This means if the company is sold or liquidated, the holders of this preferred stock get their $10 million back before anyone else. This is a substantial claim on the company's assets. They do not have voting rights on most matters, but they do have a significant financial claim. The company has been issuing shares for services, particularly to advisory board members and a development committee. While this is a way to compensate people without using cash, it also dilutes the ownership of existing shareholders. Each issuance is noted with a per share value, which fluctuates, indicating changes in their perceived stock value over time. Under commitments and contingencies, they mention a merger agreement with SMS Group, which is focused on producing carbon neutral precious metals. This has been in the works since January 2022, and several conditions need to be met, like completing audits, SEC filings, and shareholder approval. This merger could be a significant catalyst for the company if it comes to fruition. Now let us look at management's own take on their situation. They include a standard cautionary note about forward-looking statements, warning that actual results could differ significantly due to various risks like economic conditions, geopolitical tensions, and their ability to develop and commercialize products. This is important because it sets expectations that not all their plans might work out. They reiterate their business plan to build a permitted custom processing toll milling facility on their Tonopah property in Nevada. They are still in the exploration and development stage, needing permits to start construction. This explains why they have no revenue yet. The comparison of their financial results for the 3 months ending the 30th of September 2025 versus 2024 shows a 49% increase in their net loss. This is largely driven by those rising general and administrative expenses and interest expenses we discussed earlier. They highlight increased consulting, professional, and engineering fees. It is important to remember they had no revenues for either period. This is consistent with their stage of development, but it means all their expenses are outgoings without any income. Until they can start processing and generating revenue, every dollar spent is a step closer to needing more funding. This section reinforces the going concern issue. They have financed operations through stock sales and debt, but have a massive accumulated deficit. They need additional capital and are actively seeking it through debt and equity. The lack of positive operating cash flow and a very low cash balance are serious concerns. They note that their capital structure shifted from debt to equity due to debt conversions. This reduced interest expense, but increased shareholder dilution. This is a common trade-off for struggling companies. The cost of capital remains high, meaning future fundraising could be even more expensive or dilute ownership further. This part discusses their internal controls over financial reporting. Management concluded that their disclosure controls and procedures were not effective as of the 30th of September 2025 due to material weaknesses. This is a serious disclosure. It means they do not have robust systems in place to ensure their financial reporting is completely accurate and reliable. They list specific material weaknesses. One is entering into material transactions without proper documentation, like signed agreements and board approval. Another is a lack of evidence of review for account reconciliations and journal entries, attributed to limited personnel and technical expertise. They are trying to fix these, but it will take time and resources. This lack of strong internal controls increases the risk of errors or even fraud. And that brings us to our take. American Clean Resources Group Incorporated is in a very precarious financial position. Their balance sheet shows significant liabilities, a large accumulated deficit, and critically, a very small cash balance. They are heavily reliant on related party financing through convertible notes which are accumulating substantial interest. The company is essentially an exploration stage entity with ambitious plans to build a toll milling facility and develop renewable energy projects. However, they have no current revenue, and their operating losses are growing quarter over quarter. The going concern warning in their own report is the most significant indicator of their fragility. They absolutely need to secure substantial additional funding to move forward with their plans and avoid ceasing operations. The material weaknesses in internal controls are also a major concern, suggesting that even if they do secure funding, there is a risk of financial misstatements. While the mineral rights and the potential merger with SMS Group offer some hope for the future, the immediate financial realities paint a picture of a company fighting for survival, heavily dependent on its ability to attract new capital. Think of it like a startup needing a massive investment round, but with the added complexity of significant existing debt and a lack of robust financial processes. The path forward is extremely challenging and fraught with risk. Alright, that is our breakdown of American Clean Resources Group Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more community insights. Thanks for watching. See you next time.